This week's market story was a whirlwind. We had geopolitical flare-ups in the Middle East sending oil prices onto a roller coaster, a cautious thaw in the US-China trade talks, a fresh CPI print, and a strong 10-year and 30-year Treasury auction. Stick around as we unpacked how these forces shape stocks this week. Over the week, all major indexes finished lower, but these figures mask some intra-week swings. Markets initially rallied this week on hopes of renewed US-China trade dialogue and a softer than expected CPI print, only to reverse course when tensions in the Middle East rose significantly at the end of the week and caused oil prices to spike. Therefore, showing how quickly investors pivot between growth optimism and risk aversion. Now, let's start with the geopolitical shock that rattled markets to finish the week. On Friday, reports emerged of Israel doing a significant strike to Iranian targets. In response, Iran signaled retaliatory moves. Because the Middle East supplies a significant share of seaborne oil, any threat to the supply coming out of the Strait of Hormuz drives traders to bid up the price of crude, causing oil prices to jump over 7% on Friday alone, with Brent settling near $73 a barrel. Therefore, the higher energy costs reignited some concerns about inflation, prompting a late week pullback in the equity markets and driving investors towards safe haven assets such as Treasury and gold. On Wednesday, the May CPI report showed that consumer prices rose just 0.1% month over month, with the headline inflation coming in at 2.4% year over year. Core CPI, which is excluding food and energy, also rose just 0.1% month over month and 2.8% year over year. Because the print was modest, despite lingering tariff concern, it reinforced the view that underlying inflation pressures remain manageable, causing Treasury yields to ease after the release and equities initially rallied. Therefore, investors took the CPI report as a win. Into the oil-driven risk-off event later in the week, reminded investors that upside inflation surprises can still arrive via geopolitical shocks. Tie it all together and you see why markets swung a bit this week. Now, before the Middle East flare-up, investors were cheered by signs of progress with the US-China trade talks. Earlier in the week, reports indicated that US and China resumed their trade negotiation and discussions on trade frameworks, focusing on tariff rollbacks, technological cooperation, and supply for rare earth minerals. Because these talks came after months of tariff uncertainty, investors greeted any sign of dialogue as a positive. Therefore, sentiment improved briefly, with stocks rallying on the hope that reduced trade friction could support corporate earnings growth later in the year. Now, while geopolitical events grabbed headlines, the bond market was quietly testing investor appetite in the background. On Wednesday, the Treasury sold $39 billion of 10-year Treasury notes at a yield of just over 4.4%, which was notably below pre-auction forecasts, signaling robust demand. But the real test came on Thursday, when $22 billion of 30-year Treasury bonds were auctioned at approximately 4.84%, again cheaper than expected, showing strong demand for the longer-term Treasuries. Now, with bond demand holding up even with higher yields, let's wrap up what to watch for as we head into next week. So, what's next? We have to keep an eye on developments in the Middle East. Any could calm oil markets and lift equities, while renewed hostilities could prolong risk aversion. And from the looks of it right now, that's most likely the case. Continue to watch US-China trade talks for concrete progress on tariffs, as real breakthroughs here could signal a more durable rally. But remember, in this environment, with all the geopolitical tension, headlines can trigger some pretty swift market moves. Let me know how you're positioning due to all the geopolitical events out there. Share your comments below. And as always, like and subscribe for more content and more context.